Socking away a pile of money for a down payment on your first home is easier said than done. First-time homebuyers often combine saving for a down payment with other financial strategies. The best one will help you clear the down payment hurdle without jeopardizing your finances in the long run. Hey everyone, it's your favorite local realtor, Adam Burnell. Happy Monday to you all. I'm so happy to see you all again. I hope you all had a great weekend. I know I sure did. Today I wanted to talk about down payments. Here are some options that first-time homebuyers use to come up with a down payment. Not all of them will be right for you, so consider the benefits and the drawbacks carefully. Number 1, low down payment mortgages. Traditionally, lenders have preferred 20% down, but many low down payment options are available, especially to first-time homebuyers. VA loans, which are backed by the Department of Veteran Affairs, and USDA loans backed by the Department of Agriculture offer 0% down payment options for borrowers who qualify. FHA loans backed by the Federal Housing Administration allow down payments as low as 3.5%. Conventional loans, which aren't backed by the government, offer down payments as low as 3% to first-time home buyers with a good credit score. A smaller down payment requirement may enable you to buy a home and start building equity sooner rather than later. The drawbacks for this method are, making a small down payment can trigger extra expenses. Mortgage insurance, which protects lenders against loans that default, is required on all FHA loans and on conventional loans with down payments less than 20%. VA loans have a funding fee, which can be rolled into your monthly loan payment. A lower down payment usually means you're going to pay a higher interest rate. State and local down payment assistance. Many states have down payment assistance programs implemented by government agencies, nonprofit foundations, and even employers. The assistance usually comes in the form of grants or zero-interest forgivable loans. The programs can have a geographic focus as wide as the nation or as narrow as a city. There are also hyperlocal initiatives targeted as tightly as neighborhoods and even house by house. The drawbacks. Programs usually set a maximum sale price and some have income limits, so not all home buyers will qualify. Still, it's definitely worth checking out programs in your state. Number 3, down payment gifts and loans from family. It's not uncommon for first-time home buyers to get help from family members. Of all home buyers ages 28 and younger, many of whom are most likely first-time home buyers, 28% of them used a gift from a relative or a friend to help make a down payment, according to the 2019 National Association of Realtors. Of all buyers ages 29 to 38, 21% used a gift. The drawbacks: using a gift to supplement savings can help first-time home buyers clear the down payment threshold, but buyers who have to rely exclusively on gifts from family members may be unprepared for the full cost of owning a home. Number 4, crowdfunding a down payment. Sites like featherthenest.com and homefunded.com let you build an online profile and raise money for a down payment. Feather the Nest works like a gift registry where contributions to your down payment or other home needs can be funneled into a linked bank account. The service seems particularly suited for engaged couples and newlyweds. CMG Financial, a mortgage banking firm, provides the home funded service. To use Home Funded, you have to get pre-qualified from a mortgage for a mortgage from CMG Financial first. Then you can use its crowdfunding tool to raise money for your down payment. You also have an opportunity for a $1,500 closing cost grant with free home buyer education. The drawbacks for this particular method: watch out for fees or obligations when using a crowdfunding strategy. The transaction and credit card processing fees for Feather the Nest total 7.9% plus 30 cents on each donation. Home Funded doesn't charge fees, but you can't shop around for a mortgage lender either. You must use CMG Financial. Number 5, retirement account withdrawals or loans. Some first-time home buyers tap into retirement savings for a down payment, but this option should be approached with some caution. The rules and consequences for using retirement money for a down payment before age 59 and a half vary from the type of account. Employer-sponsored 401k plans may allow for early withdrawals or loans. You'll pay income taxes and an additional 10% tax penalty on an early withdrawal. If your plan allows a loan, you must repay the money with interest to avoid income taxes and a penalty. Some 401k plans give you more than 5 years to repay a loan for a primary home. If you leave your job, loans must be repaid or rolled into an eligible retirement account by the next tax filing deadline, or you'll pay taxes and a penalty on the borrowed money. Traditional IRA withdrawals for the first-time home purchases are allowed up to $10,000. You will pay income taxes on the withdrawn money, but won't face an additional penalty if the money is used to buy or build a first home. Roth IRA withdrawals are tax-free and without penalty for a first-time home purchase if you've had the account for at least 5 years. The drawbacks: taking money out of your retirement savings early can set you back on long-term savings and make it hard to catch up. Plus, you miss out on tax-free growth or any of the money you withdraw. Financial planners generally don't recommend this strategy because most people are already behind on retirement saving. So use your best interest. Well guys, I hope you enjoyed today's video. If you liked it, be the cool guy or girl and give it a thumbs up. As always, if you have any questions, leave them in the comment section down below and I'll make sure I get back to you. Have a great rest of your day and I'll see you soon. Bye-bye.